So I'm going to start with the one of the most fundamental questions that I often get, and which is, you guys talk about 100% rule based. You are 100% rule based shop.
Yep.
Is this actually more of a just something that you should say because it sounds good, but does it actually really work to generate alpha compared to any of the other approaches? So how do you respond to that?
When you say mutual fund, people believe active funds.
Active
So
funds.
there's a manager who is doing a active stock picking.
Correct.
Okay. Now, what do you mean by stock picking? The idea is to generate alpha over the market, beat the market, and generate an additional 2-3% on an annualized return basis.
Right.
Okay.
Right.
That's the goal.
Right.
Okay. So how it is done? The manager do their research. Okay. They scan the market for the opportunities, and they look for mispricing opportunities. That is market anomaly.
Correct.
Okay. So if they find some opportunity where they believe that the stock's actual price is nearly, let's say, 150 and it is trading at, let's say, around 60 or 70 or even 100.
Right.
Okay. So it will eventually converge to that real price, to its actual value.
Right.
Okay.
Right.
And thereby it will create a significant alpha over the market. If you look at the track record of last 18 years, okay, out of those 18 years, in 13 years, a big majority of large cap active funds
Okay.
have underperformed the benchmark.
Wow.
Okay.
13 out of 18.
13 out of 18. In mid cap, it started to hit the market in mid 2010s.
Okay.
If you look at the mid cap space, okay, then in last 10 out of 18 calendar years, okay, a big majority of mutual funds, active mid cap mutual funds have underperformed the mid cap 150 benchmark. Okay. Look at the last year. Mid cap index returned around 45%. It was a boom time. Okay, for mid cap investors. 90% mid cap funds have underperformed the benchmark.
Wow.
Average universe return, there was for average universe, there was a negative alpha of 7%. Okay.
In the mid cap space.
In the mid cap space. The major problem is that it's not that active managers, the managers have lost their capability to pick winners. Okay. Or there is some problem with the overall their research process.
Yeah.
The issue is alpha is not there. Okay. As I mentioned already. So what happened typically if manager give a return equivalent to benchmark, okay.
That's not good enough.
That's not good enough.
Yeah.
Investor would say, I can simply invest in index fund which is available at 5-10 basis point. Why should I pay 100 basis point to you?
Correct.
Okay.
Correct.
So they have to generate alpha. They have to take that risk. And in their desperation, sometimes they get into mispricing trap. Okay, they believe that the stock is trading at actual value is 100, which is trading at 80. There are red flags which tell that actual value might be 80 only. Okay, but they still go for it. Okay,
yeah, because you have to take a bet.
You have to take a bet.
So how does this problem? How do we solve this using our 100% rule based approach?
If you look at the NSE benchmarks, which are there around factors, so there are benchmarks around quality, momentum, volatility. They are already out there.
Right.
Okay?
Right.
NSE has created them. Their indexing team has created them.
Yeah.
Literally every single factor has beaten the benchmarks over long term. What we are trying to do, we have tried to implement those time-tested factor strategies in Indian context. Okay, and we use a rule-based approach for that.
Okay.
So first step is to observe whether there is a significant alpha which is available or not. That's the first point. First
for that particular factor.
For that particular factor and factor definition.
Right.
Say.
Yeah.
If significant alpha is there or not. Then second is what is the source of the alpha? What is the consistency of that? What is the sustainability? What is the predictability? In which market conditions this alpha would be significant? In which market conditions the alpha would be, alpha would contract?
Right.
And in some market condition, alpha can be negative as well.
Okay.
It can be negative as well. Okay. And the most important part is the predictability of alpha. That whether alpha is predictable in future or not.
Right.
Okay. Whether it's replicable or not. Okay. So on those basis of those parameters, factors and factor definitions have been framed. Okay. And the thing about rule based is, so once a factor has been tested, a factor definition has been defined, basically stock selection criteria, weighing criteria, okay, and the review frequency, like it will be quarterly or annual or something like, or semi-annual, okay. It has been decided and it has been tested for its alpha sustainability. Okay. And it's finalized. We believe that's a right strategy for clients and it can be offered to the our client base. Okay.
I also want to create that short-term alpha, right? Like say in a 3-year time horizon, in a 5-year time horizon. How do I make that happen?
So we build a tactical risk rotation model. Okay. We introduced that to our factor universe.
Okay.
In tactical risk rotation model, we basically use 5 parameters: US VIX, India VIX, Nifty 50 regression model, Nifty 50 valuation multiples, and India government bond yield. Okay. Using these 5 parameters, we generate a leading indicator.
Okay.
That leading indicator tells us whether it's going to be a bullish phase or bearish phase or market consolidation phase in medium to long term.
Okay.
Based on this leading indicator, we select some factors which are supposed to do well during that period and create a combination for the clients. Okay. For bullish phase, basically, if we go towards the high risk, factors like momentum, alpha, some allocation to value, or going into the smaller company universe, small cap or a bit of micro cap. During the bearish phase, we basically concentrate client portfolio towards, defensive factors.
Right.
Okay, like low volatility, a slice of dividends, a contrarian quality exposure.
Right.
Okay.
Right.
And during the market consolidation phase, we move towards moderate risk exposure.
From your point of view of, say, the actual portfolio construction, if I can come to that as the final leg of this, how do we, everything that you spoke about right now, how do we put it all together to create those strategies which the end customer is actually investing in?
See, there are 2 pieces which are moving here.
Okay.
So one are our factor portfolios, which are being managed independently.
Okay.
Second piece is tactical risk rotation model.
Correct.
That provide us a signal whether it's going to be bullish phase or bearish phase or market consolidation phase.
Right.
Then the third step is, based on these signals, we select which factors would be suitable.
Okay.
And we basically distribute allocation among those factors.
Right.
Okay.
Right.
So that's nearly 95% of money goes there on that factor bouquet.
Okay.
5% of money is basically used for strategic positioning and hedging.
So once again, thanks a lot, Karan, for the session. It was really, really engaging and enlightening. I hope people understood how we are different from everyone else out there.
Let's hope so.
Thank you.